Is negative gearing still a strategy that can be implemented today in 2024? And are there cash flow positive properties still in the market? Well, if you're wanting to know the answer to this, make sure you stick around because we're going to get into that today. If you're new to the channel, guys, my name's Julian. I'm the head of strategy here at Ripehouse, and today we are going to be getting into a deep dive on whether negative gearing is still an effective strategy in 2024. If you've just come across this video and you want to keep finding out more about property investing or just investing in itself, if you're just watching this video now and you're wanting to find out a bit more about property investing and you're not already following along, make sure you click like and subscribe to this video because here we talk about property investing and what are some effective strategies when it comes to picking the right property and what's the best strategy for you overall. But today we're going to be getting into negative gearing and whether that's still an effective strategy in 2024. Because there's a lot of content out there. I see a lot of ads that pop up in Facebook talking about negative gearing being dead. But I guess I'm here to say today that whilst it should not be the sole focus of what we're doing as an investor, we have to actually understand the conditions of the market that we're actually operating in. And as it sits right now, negative gearing is not necessarily part of our strategy, but it's a little bit harder to avoid. But as we go into what is negative gearing, and that's probably the big thing we want to explain what that is. So negative gearing, to kind of give you a bit more of a minute breakdown in terms of what that actually involves, is when you've got your property, it's sitting there, but it's got a lot of outgoings. So you're actually losing income from that property as we go along. So we have our rental income coming through. But, our interest, we may be paying principal, we may just be paying interest, or we've got our rates, water and insurances. And essentially we're running at a loss minus even with our rental income coming through. So we have a deductible loss. And negative gearing is essentially a more of an older strategy where higher income earners, I should say, would go out of their way to deliberately buy properties that would reduce their income. Now, why is that, I guess, not the ideal thing to do? Because, historically speaking, people would go out there and buy low-yielding properties that would, be losing them heaps of money, but they'd feel they're getting their tax back, so they're winning. But I guess understanding negative gearing as a whole, the tax man, and we'll just use a blanket number here, saying that you've lost $10,000 on a property per se. The tax man's not going to turn around and go, well, I'm really sorry to hear that. Here's the $10,000 back to you. And you're on your way. That's not actually how it works. So it's a lot of it is to do with what your marginal tax rate is. So if you are sitting at the highest tax rate and you're getting it taxed at 45%, you're going to get $4,500 back or around that mark of that $10,000 loss that you've got. So you still actually lost $5,500 to hold that property. Now, why I say in today's market is negative gearing still potentially a part of our strategy, and we're going to get into that a little bit in a moment. But firstly, are there still legitimately cash flow positive properties, and can we make it work in regards to our overall strategy? Because we need to understand that whether a property is cash flow positive or not is going to be hugely dependent on what our outgoings are. So if we've got a property and we've maxed out our borrowing, we've gone up to 90% LVR and we're getting the highest interest rate possible, it is, unless you're getting into probably what I would call nightmare properties, being that they're share homes or they're NDIS properties that are bringing in large rental income, but they come with their own little caveats, that's a discussion for another video. It's really, really going to be hard for you to find a cash flow positive property. Another way that sometimes people look to offset whether their property is cash flow positive or not is through depreciation. So they go out there, they buy a brand new property with all the bells and whistles. And if you're not aware how depreciation works, so when you build your property, not the land, but the actual house itself depreciates over a 40-year period. And there's certain segments, some go up 5, 10 years, they break down. You're depreciating the actual construction of the property. And again, just like your losses in terms of your cash flow, you're going to use that depreciation to offset your losses. Now, is that an effective strategy in itself? Well, there's some arguments that can be made here where you may be building, and we've done a very long case study on this on a separate video, looking at over 9,000 new home builds, where when you're buying a property and it's a brand new build, typically speaking, you're going to see subpar performance in your first kind of 5 to 7 years while you're holding that property. And the reason for that is that we need to understand that the thing that appreciates in value over time is not this. It's not the shiny brand new property that you've built bespoke to you. It's the actual land that it's sitting on that appreciates in value. So whilst you're sitting in those newer build areas, typically whilst your home's being built, there's other homes around you coming through that are continuing to be built. And same as infrastructure, maybe the shopping centres aren't all built out yet, train lines, schools, hospitals, universities, whatever it may be. So we're in an area that's less desired than other established areas. So our land value isn't as desired as those established areas. So you typically what you're going to see is, though you'll get that depreciation benefit, you're not going to be getting that land appreciation, which is really what helps us excel our wealth creation as a property investor. And the other thing we need to understand as a property investor, the reason appreciation and that capital growth should be the number one focus of our property investment strategy is because we are doing what's called, we are leveraged. So we are not going out there in most cases, taking our cash and buying a property outright. We are getting loans where, the bank is giving us essentially 80 to 90% of the money. And that leverage is really what accelerates our growth. It can be as much as 20 times faster depending on how leveraged you are versus just investing in your own name. So it's really it's important to understand that leverage is tied to that capital growth performance. In terms of depreciation, not so much at all. And that leads to the question I put earlier in the video, is in terms of, can we still find positively geared properties in today's environment? So the blunt answer to me, unless you are going to be in those properties that are, like I mentioned, your share homes, your NDIS homes, which again, they come with expensive builds. They're very, very hard to, consolidate the capital growth in comparison to other nearby properties, because you're normally starting at a negative equity point in comparison to other properties nearby. And when it comes to reevaluation, valuer comes by, he needs to see comparable sales nearby. How many properties in the neighborhood are 4-bedroom, 4-bathroom homes, as an example? But if we go to positively geared properties, most loans at the moment for an investor are going to be somewhere between that kind of 6.5% to 7% number. Now, and that's on a 80 or 90% loan. And then you've got your running costs per week, so we're talking about rates, water, insurance, general maintenance each year, land taxes, if that's applicable to you as well. So when we start stacking up those items, if we've got a investment that's, running at say 6.5%, 7% interest rates that we need to take care of, then we've got these outgoings, and those outgoings throughout the year may be costing us anywhere between $150 to $250 per week. It's pretty hard for an investment property to be running positively geared. And the reason I say that is, even if the yield is 7%, that is not going to offset all those costs as well as the interest. In most cases, you would need to be seeing properties at around an 8% plus yield. And if you know where they are and they're in good locations and they're 3 or 4 bedroom homes, please send them to me as well, because I'd like to buy some. But in reality, being serious, they're just not really out there. Now, we need to understand the conditions that we're in, though. Right now, we've seen ourselves come from essentially 0% interest rates, 2% on the retail side, and we've gone up very, very quickly. And now we're at the point where we're stabilizing, and talk is still around, when is the next cut coming? So we're seeing those rates stabilize, but we're still seeing rental prices increase. So if you're initially getting into an investment today, it's highly likely that that property is going to be negatively geared, unless, like I mentioned earlier, you're going to come in and you've got a higher deposit amount. Maybe you're at a 30% deposit or a 40% deposit, then you may be neutrally geared. But the reality is, if we continue to hold these properties medium to longer term, even if interest rates stay where they are, as rental increases start to increase, we're going to start to see these properties get less and less negatively geared to the point where they're neutral or positively geared. So it's understanding the capital growth is the number one reason that we invest in property as an investor. We want to take this $500,000 property, or whatever the price of the property is that we buy, and the long-term average of property is that it doubles in value every 8.5 years. So if we can turn that $500,000 into $1 million, that's a fantastic return. Whether I'm losing, $50 a week, that is not a big deal when I understand the number one thing that I'm focusing on is the end goal, is walking away with that big nest egg at the end. Guys, I hope you liked today's video. If you would like to know more about property investing, or you're still trying to find your feet and maybe need a little bit of help along the way, for today's video, I'm just going to put a link below where you're able to actually contact me directly, and more than happy to take your calls and, find out, give you a bit of guidance in terms of what you're looking to do in your strategy moving forward. It is limited to the first 10 people that, subscribe in that link below. So make sure you click that button and reach out to myself. If you liked the video, make sure you smash that like button and subscribe, and I'll catch you guys in the next one. Bye for now.